Hello everyone, and welcome to episode 23. In this chapter, we'll be discussing narrative, what it is, its impact on analysis, how to build it effectively, and the difference between time-based and price-based narratives. We'll cover all of these aspects in detail, and by the end of the chapter, you'll have a clear understanding of how to construct a strong narrative and seamlessly integrate it into your analysis. So without further delay, let's get started. Alright. Let's break down what narrative is and why it's such a crucial concept. First, let's start out with an introduction and definition. Why does narrative matter in the first place? Narrative is essentially the story that price tells over time. It helps you understand the interactions that's happening in the market. It's not just about isolated price action, but about connecting every moment into a cohesive structure to form a clear directional bias on how price will reach the draw on liquidity. Think of it like piecing together a puzzle. Each price movement, every reaction at a key level, and all market behaviours contribute to the overall story. The goal is to understand where the market is headed, when it will get there, and why it's moving towards a particular liquidity pool or zone. These are the questions that narrative helps answer. It provides clarity and direction, cutting through the noise of random price movements and allowing you to trade with confidence. A strong narrative answers three key questions about price behaviour and market movements. The first is how the price will reach the draw on liquidity. Narrative helps you understand the path price is likely to take. Will it create a manipulation profile before expanding towards liquidity? Will it respect a dealing range or key levels along the way? Will it form a retracement profile before expanding? These insights allow you to make informed decisions about price movements and how you position yourself in the market. Without a clear narrative, it would be difficult to determine what market profile the price is currently following or what to anticipate next. Understanding price movement provides a framework for trade setups, helping you align the market structure and price behaviour. The second question is why price is likely to move towards the draw on liquidity. Narrative explains the reasoning behind market behaviour. Is the market targeting liquidity pools above swing highs or lows? Are institutions driving the price to collect liquidity before making a significant move? Understanding why price is moving gives you a confidence in your directional bias. It ensures that your trade ideas and setups align with the broader market forces rather than just reacting to short-term fluctuations. The third question is when price is expected to reach the draw on liquidity. Timing is crucial in trading, and narrative provides clarity on the timing aspect. Will price reach its target during the London or the New York session? Does the market need to consolidate before making a move? Are different market profiles forming at different times of the day? For example, during the Asian session, the market often remains in a range. In the London kill zone, depending on the higher time frame, order flow, draw on liquidity, and key levels, the market may experience either a delayed protraction or a normal protraction. These are market profiles that help you form a time-based narrative which answers the question of when price is expected to reach the draw on liquidity. By answering these questions, narrative helps traders avoid unnecessary trades and focus on high probability windows of opportunity during the day. Ultimately, narrative is the bigger picture. It tells a story of price and connects all the small moves into a cohesive framework. It provides direction by explaining how, why, and when price is likely to move towards liquidity. Most importantly, it gives you clarity in your trades. With a strong narrative, you're no longer reacting blindly. Instead, you are trading with intention, understanding the market's true story and capitalizing on it to your advantage. That is what narrative helps you achieve. Now let's move on to the next slide and talk about the importance of narrative and how it helps in trading. A well-defined narrative is the backbone of accurate market analysis. It answers key questions about price behaviour, key levels, timing, and market participation. By understanding these elements, you can trade with confidence and clarity. When I refer to narrative, I'm talking about the story that price tells over time and the framework that helps answer the most critical questions in market analysis. One of the most important questions narrative helps answer is which key levels to choose and why those particular levels are significant. Narrative guides you in identifying and selecting correct key levels that align with the current high time frame market story and context. For example, if the market is drawing towards the higher time frame liquidity pool, the narrative will help highlight why specific daily or 4-hour key levels, such as an order block or breaker, is critical. It also shows you how you can use the key level to position yourself and take advantage of an upcoming range expansion. This is essential because if you choose key levels randomly without understanding their role in the bigger picture, you're just guessing. Narrative eliminates that guesswork by providing context that can be exploited to gain a statistical edge in the long run. Another critical question is which candle ranges or CRTs to select and why they fit the current structure. Narrative helps determine which CRTs are relevant based on market context and which specific candles to use when positioning yourself in the direction of the higher timeframe draw on liquidity. A well-defined narrative also tells you when to wait for a liquidity purge or a manipulation profile. This is crucial because it helps you understand when patience is necessary and when it's the right time to enter the market. For example, if price is consolidating near a key level, the narrative might indicate that a liquidity purge is likely before the actual move occurs. Instead of entering too early, you wait for the market to grab liquidity, manipulate traders, and then reverse. Only after this happens do you position yourself to capitalize on the expansion. This is exactly how turtle soup setups are formed. The importance of this cannot be overstated because entering prematurely can cost you both money and confidence. Narrative teaches you when to be patient and when to engage with the market once it reveals its hand. Another crucial question that narrative answers is whether you should be even trading at a given moment. Not every market condition is worth your time. Narrative will provide clarity on when to anticipate and when to stay on the sidelines. If the market is choppy, lacks a clear directional bias, or is moving unpredictably, narrative might suggest stepping back and staying risk off. On the other hand, if the market structure is clear, price is aligning correctly with key levels, and a strong high time frame liquidity target is in play, that's your signal to act. Knowing when not to trade is just as important as knowing when to trade. Avoiding low quality setups not only protects your capital, but also keeps you mentally focused and confident. Finally, narrative helps integrate all of these pieces into a structured bias. It ties together high time frame key levels, candle ranges, timing, and liquidity behavior into a cohesive story. This story answers the how, why, and when of the market movements, providing a structured and objective approach to trading. For example, if the narrative suggests that the market is drawing towards a daily high or swing low as a higher time frame liquidity target, then on the 4-hour time frame, you can select a relative candle range. Using this structured approach, you can position yourself around that range on the lower time frame during key market sessions to capitalize on the expansion. This will remove uncertainty, and instead of trading based on hope, you're trading with a well-defined plan that aligns with the market's true intentions. The key takeaway is that a well-structured narrative is essential for making informed and intentional trading decisions. It answers critical questions such as which key levels to use, which candle ranges to trade, when to wait for setups, when to act, and when to step aside. Most importantly, it ties everything together into a structured framework, ensuring that every trade is backed by a logical and objective approach. Now that we've discussed what narrative is and why it's important, let's move on to the different types of narrative and the concepts that build them. There are two key types: time-based narrative and price-based narrative. Let's explore time-based narrative in detail. A time-based narrative relies on time concepts within the charts, such as weekly profiles, intraday profiles, and the orientation of the Asian range to form a structured bias. It's not about what price is doing, but about when it's doing it and why that matters. By anchoring your analysis to specific timeframes, you can better predict market behavior and position yourself with clarity and precision. At its core, this approach answers three critical questions: why price is moving in a certain way, how it will reach its target, and when it's the most likely time for a significant move to happen. Weekly profiles play a crucial role in this narrative. The market moves in structured profiles and cycles, following a rhythm of accumulation, manipulation, and distribution. A weekly profile maps out these processes within the weekly range, helping you to understand the characteristics of each trading day. Monday often establishes the candle range by creating or accumulating liquidity. Tuesday and Wednesday tend to form the high or low of the week, expanding on Monday's range after taking liquidity. Thursday may act as either continuation or reversal, depending on higher timeframe order flow and key levels. If the weekly objective has been reached, it's likely to reverse, otherwise it will continue. Friday can either be a consolidation day if the objective has been hit, or continue the expansion if liquidity targets remain. The key point about weekly profiles is that they evolve throughout the week. As the market structure changes each day, the narrative adjusts accordingly. For instance, if liquidity builds on a Monday and Tuesday, Wednesday might trigger a midweek manipulation move, forming the high of the week before price expands lower on the Thursday and Friday. By understanding this, you can position yourself strategically rather than taking premature trades. Intraday profiles serve a similar function, but within a single trading day. Just as weekly profiles help dissect the weekly candle, intraday profiles break down the daily candle and the range expansions occurring within a single trading day. These profiles focus on the daily narrative and how price interacts with session-specific levels and events. Each trading session has its own characteristics. The London session is known for its expansion phase, where price often manipulates liquidity before making a directional move. The New York session typically either continues or reverses London's move based on key levels, dealing ranges, and premium and discount zones. London close, the Asian range, and the central bank's dealing range each have distinct session-specific behaviours that must be understood and integrated into a broader market framework. Understanding intraday profiles allows you to tailor your trades to session dynamics, ensuring that you are trading in sync with the market's rhythm rather than against it. The orientation of the Asian range also plays an essential role in time-based narrative. The Asian session often follows a range-bound or consolidation profile, making it a valuable reference point for the rest of the trading day. It provides guidance on where manipulation is likely to occur and where expansion might play out. For example, if the drawn liquidity is lower and the Asian range forms just below a 4-hour key level, the logical expectation during London's session would be for price to take out the Asian range liquidity and test the 4-hour premium key level before expanding lower. This is how we would build a narrative, by anticipating that price will grab liquidity first before making its true move. This behaviour aligns with the principle that the market makers seek to take out retail traders and their liquidity before initiating the real expansion. By understanding the orientation of the Asian range and integrating it with broader market structure, order flow, and the open high-low close concept, traders can make informed decisions with confidence. A time-based narrative is about connecting the dots between price action and time, whether it's the weekly cycle, the daily session, or the Asian range. Mastering this approach means you're no longer just reacting to the market, but actively predicting its next move with clarity and confidence. By effectively timing your trades, you gain a significant edge, ensuring that your entries and exits align with key moments of liquidity shifts and market structure changes. Now that we've covered time-based narrative, let's move on to price-based narrative, which is just as important. Later, we'll discuss how to integrate both types to create a more logical and cohesive market story. Using each type alone makes them redundant. They only serve a purpose when combined under the right frameworks and circumstances. A price-based narrative relies on key concepts such as the open high-low close, market maker models, and the power of three to explain why and how the market moves. It focuses on liquidity pools, relative highs and lows, and structural price behaviours. By understanding this narrative, you can anticipate where the market is likely to go and why it's moving in that direction, ultimately allowing you to make informed trading decisions. The OHLC concept acts as an objective tool for defining anchor points during the trading day or week. These key levels serve as key reference points, helping determine market structure and momentum. If the drawn liquidity is lower, the objective would be to sell above the daily or weekly open. In bullish market conditions, the goal would be to buy below these levels. If price remains above the daily open, it suggests bullish momentum. If it stays below, it indicates bearish momentum. This concept is foundational to price-based narratives because it provides structure to market behaviour and helps traders align their positions with the overall trend direction. Liquidity pools play a significant role in forming price-based narrative. These zones consist of clusters of stop-loss orders placed by retail traders above swing highs or below swing lows. Since institutional traders and market makers target these liquidity areas, price often manipulates these levels before making its true move. For example, If price sweeps a daily high during a key session, such as the London kill zone, and then reverses sharply, it indicates that liquidity has been taken and that the market is ready to move in the opposite direction. Liquidity pools must be analysed in conjunction with key levels and dealing ranges to build a logical market story. Another key concept is the power of three, also known as AMD, or accumulation, manipulation, and distribution. This framework simplifies market behaviour into three phases. The accumulation phase, where price consolidates and generates liquidity, often seen in the Asian session or within the central bank dealing range. The manipulation phase follows, where price grabs liquidity above or below the accumulation phase. This is commonly observed in the London session. Finally, the distribution phase occurs, where price expands in its true direction, aligning with the higher timeframe liquidity objectives. To use the power of three in building a narrative, the first step is identifying the accumulation phase. Next, observe whether price manipulates above or below the consolidation based on the higher timeframe draw on liquidity. Finally, position yourself in the distribution phase after the manipulation move has been confirmed. Price-based narrative acts as a roadmap for understanding the market's behaviour. By focusing on OHLC levels, liquidity pools, power of three, dealing ranges, and premium or discount concepts, traders can form structured biases and execute trades with confidence. When combined with time-based narrative, price-based analysis helps create a comprehensive understanding of market dynamics, ensuring that trade decisions are well grounded in logic and structure. Now let's move on to an advanced but essential concept, combining time-based and price-based narratives in a logical and objective manner. While these narratives can work individually, their true power lies in their integration, creating a clearer and more comprehensive picture of the market. Time-based narrative focuses on when price is likely to move, analysing how it interacts with specific market phases and liquidity shifts at key times. For example, weekly profiles break down the weekly candle and range expansion, while daily profiles analyse the daily candle. Kill zones, such as the London and New York session, have distinct characteristics and outcomes depending on the framework being used. Price-based narrative, on the other hand, focuses on where price is relative to key levels, including open high-low close levels, liquidity pools, key PDRAs, and dealing ranges. When both narratives are combined, they help answer key questions: when the market is likely to move, where the price is likely to go, and why specific levels are significant. Trading isn't about knowing where price might go, it's about understanding when it's most likely to move so you can position yourself effectively. Instead of entering at the wrong time and getting stopped out, integrating both narratives helps traders capitalize on the move at the right moment. Merging these two perspectives offers multiple benefits. First, it provides a more complete view of the market. Time-based narrative gives the market its overall rhythm, while price-based narrative pinpoints the key levels that matter. For example, time-based analysis might highlight the London kill zone as a high probability window for manipulation and expansion, whereas price-based analysis would refine this by identifying specific order blocks or 4-hour candle ranges where these moves are likely to occur. When combined, traders can anticipate not only what the market will do, but also when and where it will happen, improving trade accuracy. Second, it helps traders understand the rhythm of the market and how liquidity shifts over time. Certain times of the day, such as the London Open, are known for liquidity grabs and manipulation, while the New York session often continues or reverses the existing trend. Price-based analysis adds another layer of precision by identifying key levels such as order blocks, fair value gaps, breakers, and liquidity pools, ensuring that traders align with meaningful market structures. Third, integrating both narratives helps traders identify high probability setups while filtering out low probability ones. For example, in the London kill zone, time-based analysis indicates that price often begins with a manipulation phase, grabbing liquidity before expanding in its true direction. Price-based analysis might then further refine this by showing that the daily low often forms at the 2 or 2.5 standard deviation level of the Asian range before expansion. By combining these two insights, traders can anticipate the price will manipulate above or below the Asian range before expanding towards the higher time frame draw on liquidity. Waiting for confirmation before entering ensures that the trade aligns with both time and price context, increasing accuracy and reducing unnecessary risk. By merging time and price-based narratives, traders gain a structured, logical framework for market analysis. This combination allows for better timing, improved trade selection, and a deeper understanding of how price moves within different market phases, ultimately leading to a more confident and strategic trading decision. Now that we've covered the concept of time and price-based narratives, let's dive in to their practical application. This step-by-step approach will help create a structured trading framework by integrating the broader market rhythm with precise levels and timings. The first step is to assess the weekly profile. Zooming out and understanding the weekly market context is crucial. It's important to ask questions like whether the price is currently above or below the weekly open, where significant movements have occurred in the past few days, and whether the market is in an accumulation, manipulation, or distribution phase. These insights provide the bigger picture and help align daily and intraday trades with the overall market narrative. Once the weekly context is clear, the next step is to zoom in to the daily. We're looking at the daily open, high, low, close. Once the weekly context is clear, the next step is to zoom into the daily open, high, low, close levels while identifying key liquidity pools and price structures that align with the weekly bias. This step involves using tools like intraday profiles, Asian range orientation, 4-hour key levels, candle ranges, and dealing ranges to refine entry points. The real power comes from finding confluences between the time-based and price-based narratives. By combining the when from the time-based narrative with the where from the price-based narrative, a clear framework for high-probability setups does emerge. For example, let's say that the higher time frame indicates that the drawn liquidity level is lower, meaning a bearish bias is in play. If today is Wednesday and on Monday formed a range-bound candle just below a premium daily or weekly key level, such as a breaker block or order block, this becomes an important reference point. On Tuesday, if price created a manipulation profile by sweeping Monday's range, testing the premium key level, and then closing lower, it indicates that the high of the week may have formed on Tuesday. This suggests that the rest of the week may see price expanding lower. With this weekly profile established, the next step is to refine the entry using daily and intraday structure. By analysing the daily OHLC levels and the 4-hour key levels, it becomes possible to determine the best trade locations. If the Asian session has formed a range and the 2 to 2.5 standard deviation zone off that range aligns with the 4-hour key level, this becomes a strong point of interest. Instead of taking an entry immediately, patience is required. Waiting for the manipulation profile during the London kill zone, particularly around the 3 AM macro level test, ensures that the trade aligns with the broader market structure. If price tests the 4-hour key level while also touching the Asian range standard deviation zone, a confirmation signal such as a change in state of delivery or a CISD, or the formation of an order block is required before entering. Once confirmed, an entry can be taken with a stop loss placed on predefined risk management rules. Following this structure allows for trades to be managed with precision. Once the London manipulation has been identified and price starts expanding, it's expected that a daily range expansion lower will follow. The trade can then be managed accordingly, with potential continuation moves occurring during the London or New York sessions until price reaches an opposing premium key level. Building a strong narrative ensures that every trade is based on an objective market context rather than impulsive decision making. While this approach requires discipline and effort, consistently practicing it across different pairs and instruments will help refine execution and improve overall market understanding. In this slide, we're going to discuss the realistic side of trading, what it truly takes to apply these concepts in the live markets. Trading is not just about theory, it's about navigating the complexity of real-world scenarios, solving problems, and developing a process that works for you. One of the most important things to remember is that creating a narrative in trading is not a one-size-fits-all approach. Every trade you take might require a unique narrative, and you may need to adjust your approach depending on the specific circumstances of that trade. Each day will represent new questions, new market conditions, key levels, liquidity zones, and timing factors that will constantly change. Therefore, It's essential to adapt your narrative to these shifting conditions and solve the puzzles that arise. The key point here is that the market never repeats itself exactly, so you must create a tailored narrative for each trade based on the current conditions. There are countless combinations of concepts and scenarios you'll encounter in the live markets, and managing this complexity comes down to a structured learning process. The first step is to master each concept separately. Whether it is the time-based concept or the price-based concept, take the time to study and understand each one thoroughly from reliable sources. Make sure you fully grasp the purpose and application of each concept before moving forward. The next step is to begin integrating these concepts with each other. Once you've mastered individual concepts, you should start combining them logically in the live markets, but not all at once. Trying to combine everything at once will lead to confusion and losses. Instead, start slow and steady by merging concepts one by one, and gradually apply them all in real trading situations. The third step involves confronting real market scenarios. The best way to learn is by directly engaging with different market conditions and situations. Each trade you analyze or take adds to your experience, teaching you how to handle unexpected outcomes and adapt to new patterns and market conditions. It's all about the repetition and experience. The truth is, you can't master trading by just watching videos or reading about strategies. The practical application of combining time-based and price-based narratives comes from hands-on experience. What this looks like in practice is that you'll need to analyze and trade across hundreds of charts over months and years. The repetition will help you identify patterns, refine your biases, and build confidence in your decision-making process. You'll encounter both days when everything aligns perfectly and days when nothing makes sense. It's crucial to approach each day with the correct mindset, adapting to whatever the market presents. The key is to learn from both winning and losing trades, using each experience to sharpen your process. Moreover, a pragmatic and realistic mindset is essential. Trading is not about finding shortcuts or magical formulas. It's about putting in the work, observing, and adapting over time to the market's conditions. You need to internalize the fact that mastery doesn't happen overnight. It requires consistent effort, building your skill set, and strengthening your ability to approach the live markets. Only then can you form an accurate and practical narrative. Remember, each trade you take is like a puzzle. The only way to solve it is by gaining experience and adding one piece at a time. Embrace the process, stay curious, and let the markets teach you what you need to know. I could give you many examples in this video, but the video is already long enough. I've done many breakdowns in my Telegram. I do sometimes tweet them, but mainly in my Telegram will I post my actual active trades, so go and check that out if you haven't done so already. Those trade breakdowns are the best resource for understanding the practical applications of building narratives, so be sure to look at them, even if you've already gone through them. It definitely is worth your time reverse engineering everything that I put out. Thanks for watching, love you all, I'll see you next week.